There's a number most Americans check before they buy a car. It's not the price of the car. It's not the interest rate. It's not the total cost over time. It's the monthly payment. And that one habit, that one tiny mental shortcut, is quietly draining hundreds of billions of dollars out of the American middle class every single year. Not through scams, not through fraud, not through anything illegal, just through a very elegant, very patient, very well-designed trap. This is the story of how it works, and why almost nobody gets out of it. Let's start with a scene you've probably lived. You walk into a dealership. Maybe you've done some research. You've got a number in your head, let's say $30,000. That's your budget. You've been responsible, you've done the math. A salesperson walks over. They're friendly, not pushy. That era is mostly over. They're calm, consultative. They ask you one question. What are you looking to spend per month? And just like that, you've already lost. Not because the salesperson is evil, not because the dealership is running some kind of con, but because that question, that perfectly innocent-sounding question, just shifted the entire negotiation from the total cost of the vehicle to a monthly number. And those are two completely different conversations, with two completely different outcomes. Here's what happens next. You say something like, I'm thinking somewhere around $500 a month. And in that moment, the salesperson doesn't hear 500. They hear 36,000 over 6 years, or 42,000 over 7. And suddenly, the $30,000 car you had in mind starts drifting. You're looking at the $38,000 trim, the one with the sunroof, the one with the heated seats, the one that's only $47 more a month. And $47 more a month sounds like nothing. It's 2 streaming subscriptions. It's a couple of coffees. It's irrelevant. Except it isn't. $47 more a month over a 72-month loan is $3,384 plus interest. But nobody does that math on the showroom floor. Nobody is supposed to. To understand why this works so well, you have to understand something about how the human brain processes large numbers. When you hear $42,000, your brain treats that as an abstract, threatening number. It activates something close to financial anxiety. But when you hear $583 a month, your brain categorizes that differently. It files it next to your electric bill, your gym membership, things that are manageable, things that are just part of life. Behavioral economists have a name for this. It's called payment decoupling. The psychological distance between the act of buying something and the act of paying for it creates a kind of numbness. You stop feeling the full weight of the purchase because the purchase never actually happens in one moment. It happens in 72 small, forgettable moments spread over 6 years. Car dealers didn't invent this, but they have perfected it into an art form. And the consequences are now showing up in the data in ways that should make everyone sit down for a moment. Let's talk about where we actually are right now. The average new car transaction price in the United States crossed $48,000 in recent years. Think about that. The average. Not the luxury segment, not the trucks with $20,000 option packages. The average transaction including every basic sedan, every compact SUV, every family hatchback. At the same time, the average monthly car payment for a new vehicle has pushed past $700 a month. $700 a month. For context, the median American household income is roughly $75,000 a year before taxes. That's about $6,250 a month. So the average car payment is now eating more than 11% of median gross income, not net income, gross, before the government takes its share. Financial planners will tell you that total transportation costs, including insurance, maintenance, gas, and the payment, should ideally stay around 15% of your take-home pay. The car payment alone is already burning through most of that budget, and that's before you've bought a single tank of gas. But here's the part that really matters. Here's where it gets interesting. Consumers didn't respond to rising prices by buying cheaper cars. They responded by extending the loan term. In 2010, the average auto loan term was about 60 months, 5 years. That was already considered a stretch by older standards. By the mid-2015s, 72-month loans became the new normal. Then 84 months appeared, 7 years. And now, 8-year auto loans are a real product that real dealerships are offering real customers with a straight face. An 8-year loan on a car. Let that sit for a second. The average car has a useful life of about 12 years if you're lucky and moderately diligent about maintenance. An 84 or 96-month loan means you are paying for a car that is actively depreciating rapidly for the majority of its useful life. It means you could theoretically be making payments on a 2025 vehicle in the year 2033, by which point the car might be worth $4,000 on a good day, but you'll have paid $58,000 for it. Now, let's follow the money, because this is where the real mechanism reveals itself. When you finance a car, there are actually two separate transactions happening simultaneously. You are buying a car, and the dealership is selling a loan. Those are not the same thing. The car purchase is the obvious part. The loan sale is where most of the profit lives. Here's how it works. You sit down with the finance manager. That's the person you meet after you've already agreed on the car, after you've emotionally committed, after you've mentally started planning where you're going to hang your air freshener. The finance manager has a job that has nothing to do with selling cars. Their job is to maximize the profitability of your financing. Dealerships have relationships with banks and lending institutions. Those banks set a minimum interest rate called the buy rate, at which they'll fund the loan. Let's say the bank's buy rate is 6%. The finance manager is allowed to mark that up. If they sell you the loan at 8% instead of 6%, the dealership captures the difference, which is called the dealer reserve. On a $45,000 loan over 72 months, the difference between a 6% rate and an 8% rate is roughly $3,000. And you would never know this is happening. It's not on any sticker. It's not in any headline. It's buried in a number that you already agreed not to focus on because you were focused on the monthly payment. And then, and this is the part that escalates beautifully, the finance manager pivots to add-ons. Extended warranties, gap insurance, paint protection, tire and wheel coverage, fabric sealant, key replacement programs, each one presented as a small addition to the monthly payment. This covers you bumper to bumper for 7 years. That's only $18 more a month. $18 a month sounds like a numbering error. Over 72 months, that's $1,296 for a warranty on a car you're going to finance for 7 years and probably sell in 4. Studies have shown that the profit margin on automotive finance and insurance products, what the industry calls the F&I office, often exceeds the profit margin on the vehicle itself. You think the money is in selling cars. It isn't. The money is in selling you the financing for the car. But wait, it gets more uncomfortable, because even if you leave the dealership having done everything right, you negotiated on price, not payment, you skipped all the add-ons, you got a reasonable rate, there's still a mechanism working against you that almost nobody talks about. It's called negative equity. The industry calls it being underwater, and it has become one of the defining financial traps of the modern American economy. Here's how it happens. Cars depreciate fast. New cars, on average, lose somewhere between 15 and 25% of their value in the first year alone. A $45,000 car might be worth $36,000 12 months after you drove it off the lot. But on a 72-month loan at 7% interest, after 1 year of payments, you might have only reduced your loan balance to $40,000, which means you owe $40,000 on a car that's worth $36,000. You're already $4,000 underwater, and you haven't even had the car for a year. Now, if you just keep making payments and eventually pay off the loan, this corrects itself over time. The equity eventually catches up. That's fine. That's survivable. But here's what actually happens. Most Americans don't keep the car long enough to pay it off. The average length of time someone owns a new car before trading it in has been hovering around 3 to 4 years, which is almost always before the loan is paid off. Which means when they go back to the dealership to trade in their existing car, they're bringing negative equity with them. And what does the dealership do with that negative equity? They roll it into the new loan. So now you're financing not just a new $48,000 car, you're financing the $48,000 car plus the $5,000 you still owed on the last car, plus the interest on all of that stretched across another 72 or 84 months. Analysts have documented cases where people, through multiple cycles of this pattern, end up with loan balances that are $10,000, $15,000, even $20,000 higher than the actual value of the car they're driving. They are perpetually underwater. They can never actually get ahead. Every new car purchase digs the hole a little deeper. And the monthly payment, which stays relatively stable because the loan term keeps getting extended, disguises the whole thing. This is not a rare edge case. A significant share of all new auto loan originations in any given quarter includes rolled over negative equity from a previous vehicle. The industry tracks this. Lenders know it. Dealerships depend on it. It's a feature, not a bug. Now zoom out, because this isn't just a personal finance story. Auto loan debt in the United States now exceeds $1.6 trillion. That's trillion with a T. It surpassed student loan debt for a period. It is the second largest category of consumer debt in the entire country, behind only mortgages. And unlike mortgage debt, which is at least attached to an asset that typically appreciates over time, auto loan debt is secured by something that is structurally guaranteed to be worth less every single year.
The delinquency rates on auto loans, people who are 60 or 90 days late on payments, have been climbing steadily. Subprime auto loan delinquencies in particular have been flashing warning signals that anyone who remembers 2008 recognizes immediately. Not in scale, let's be precise about that. The auto loan market is not the mortgage market, and a collapse in auto lending would not cascade through the financial system the way housing did. But for the individual households carrying these loans, the math is just as brutal. And here is the irony that sits at the center of all of this. The car is supposed to represent freedom. That's the entire cultural mythology of car ownership in America. The open road, the independence, the ability to go wherever you want, whenever you want. The car payment, in its current form, is the precise opposite of that. It is a monthly obligation that locks you into a fixed cost regardless of what else happens in your life, regardless of whether you lose your job, get sick, have a kid, or simply decide you want to live differently. You cannot easily downsize a car payment the way you can cut a streaming service. You cannot pause it. You are committed for years to a depreciating asset that you may not even fully own yet. The counter-argument, to be fair, is real. Most Americans need a car. This is not a luxury debate for a majority of the country. Public transit is inadequate or non-existent in vast swaths of American geography. People need to get to work. They need to take their kids to school. They need a vehicle. The question isn't whether to have a car. The question is what the true cost of how we buy them is doing to household balance sheets at scale. And there is a version of this that is defensible. A well-negotiated loan on a moderately priced, reliable vehicle kept until the loan is paid off, with the car driven for several more years afterward, is a reasonable financial decision. That version of car ownership exists. It's just not the version the industry is designed to produce. The industry is designed to produce the other version, the one where you're always in a car that's slightly too expensive, on a loan that's slightly too long, in a cycle that's slightly too convenient to escape. So where does that leave us? There's a version of this story where someone figures all this out, resolves never to be tricked again, buys a sensible used car with cash, and rides off into a debt-free sunset. And maybe that works for some people. But here's the thought that doesn't resolve neatly. The entire modern automotive industry, including the manufacturers, the dealers, the lenders, the insurers, the warranty companies, is financially engineered around the assumption that you will continue doing what most people do. That you will focus on the monthly payment, that you will trade in before the loan is paid off, that you will roll over negative equity, that you will say yes to something in the F&I office. These are not projections, they are business models, they are balance sheets, they are quarterly earnings calls, which raises a question that's harder to answer than it sounds. If tens of millions of people simultaneously decided to buy cheaper cars, hold them longer, and pay in cash or with the shortest possible loan terms, the industry as currently structured would not survive it. The margins don't work without the financing. The volume doesn't work without the trade cycle. The whole machine depends on the trap functioning. So maybe the more honest question isn't how do you personally escape the car payment trap? Maybe the more honest question is, what does it mean that the trap is the point? And whether the car you're driving right now is something you own or something that owns you.